Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. Have you ever gotten a letter that says, I want to buy your company and I've got $20 million willing to give you for your business? Well, even if someone was willing to pay that after you go through due diligence and agree on the normalized EBITDA, agree on the multiple, and agree on normalizing working capital, how you get that money is a big deal. And that is where the deal structures of a transaction come into play. I've got Dave Diehl, who is the CEO of Prairie Capital Advisors, their investment banking firm out of Chicago. I've known Dave for years. He's done a couple deals for my old partners, from an ESOP to private equity. And the reason I like Prairie Capital Advisors and what Dave does is because they don't care what exit option you want, whether it's private equity, strategic buyers, management buyouts, or ESOPs. They're willing to structure a deal for the seller's goals. And so I have Dave on to unpack deal structures for us because we need to better understand how those work, because each exit option and every buyer is going to have to structure the deal to mitigate their risk, to enhance their ability or increase the probability that they're going to get the rate of return they need. And that's why next week I've got Jeff Buettner on the podcast talking about all the different buyers and what their goals are for rates of return and how they structure those. But today I wanted to dive in with Dave of how do we actually assess working capital, because that's a big adjustment when we close a deal. But then what are all the different deal structures, from seller's note to rolled equity to earnouts to cash at closing to escrow? All these different components are different pieces of the chessboard that we need to understand, so you don't get distracted by some random LOI, someone promising you $20 million. And by understanding this, it'll better equip you to become a capital allocator and understand your own business, but also the M&A marketplace. So I really hope you enjoy this conversation with Dave Diehl. Thanks for tuning in. Dave, super excited to have you back on. This is gonna be fun.
Absolutely. Excited to be here.
So I know the conversations that you and I've had are some of my favorite ones, Dave, when we've talked about ESOPs, we've talked about, different valuations of like the cash flow valuation versus strategic buyers. I mean, it's been a lot of fun. I know a lot of my listeners and clients have really enjoyed those. And as I was thinking about some of the gaping or the gaps and topics that I've covered, deal structures is one that confuses the heck out of a lot of sellers or business owners, because you might get a price or a dollar amount. It doesn't mean you're getting that net proceeds up front. And the different buyers have different deal structures, from ESOP, private equity, management buyouts. And so what I was thinking, Dave, is I'll tee us up and just kind of, so the listener can get caught up, kind of like we're doing pre-recording, of just kind of level setting it, and then we can just take and run with it. What do you think?
Sounds good.
So it was years ago, Dave, because I was going through this buyout with one of my friends that I was helping him with, and we were talking about like the four numbers that people have to agree on in order to get a deal done. And it was the normalized EBITDA, which we've spent a lot of time on the show talking about. And then it was the multiple, which a lot of people have heard, and we've got a lot of those episodes under our belt too. You keep your cash and you pay off your debt. And then there's normalized working capital. And that right there could be like 5 episodes. I can't believe it's so complicated, but it's a math equation. But you had said, you and I were in one of our conversations, Dave, and you were just like, you said it, and it was just like, and done. It's just that simple. There's nothing else to talk about. And I was just
the bulk of it.
Yeah, right. So like those 4 numbers, and maybe you can, if you want, before we move on to the deal structures, and I'll put a container on those, is that normalizing working capital, because you got the normalized EBITDA, then there's which is the proxy for cash flow, and the multiple, which is the proxy for how many years of cash flow based on the risk. Keep your cash, pay off your debt, but that working capital, our dear friend Pat Hobby was always zeroed right in on there as a CFO. But like, not only while people own their company can they generate a lot more cash by optimizing that, but when they go to sell, they have to deliver that normal level of working capital regardless of the buyer. Anything you want to speak on as it relates to that before we move on to the deal structures?
No, I mean, I think the main thing there is for people to understand what that is, and understanding what a normal level of working capital is for their business. There are a lot of businesses that run themselves pretty conservatively when they're privately owned. And so looking at this Well, just, there's a lot of people who are debt averse. There's a lot of people who will maybe maintain more inventory or whatnot for reasons that are less than optimal from running a business. It's just something that makes them feel comfortable. So we always want to go in and understand, what this really is. I mean, what is a normal level of working capital? So certainly want to look at the industry in general and see, okay, well, what's the industry running at from that standpoint? And does this company differ from the industry? And if so, why? So if it is a case where maybe the company is a little bit different than the industry norm, and that they maybe they're in something that's a little bit more unique, and the products that they're offering they need to have on hand, and that's a competitive advantage for them, and it allows them to charge greater margin. Great, then maybe you do need some additional inventory or whatnot. But so there's plenty too that I know you mentioned cash, but there's people that manage their lines of credit and cash a little differently too. So we want to get in and understand what that is. But a lot of that is interpretive. So I think it's important when you go into a discussion with a buyer. I mean, I know the focus is always on the multiple, but like first off, it's what are you multiplying against? So you need to understand what normalized EBITDA is and make sure that they're buying into that to really understand, how this all translates. But usually the multiple is you come to and derive after you've received an actual cash value offer. The problem is that working capital tends to be an afterthought in a lot of respects, and so you'll see someone that agrees to a certain price, and it just says, based on normal levels of working capital, and then they realize that there's a rather large disparity between their vision of working capital and the buyer's vision of working capital, which can create a differentiation in the end proceeds, which is really what's important. So, I mean, there's people that really try and extract value as they're negotiating this because of the working capital, and hoping to address that later on in the process when somebody's already fully invested in selling the business.
Let's unpack a little bit, because I think this is so helpful for a myriad of reasons, Dave, before we get into just the deal structures and how the different buyers or combine the deal structures. Because at the end of the day, what we're trying to do on this conversation is if one of the people listening in says, I want to monetize my asset. Well, okay, they're going to get a certain amount of net proceeds up front and then a certain amount over time, depending on all these different risk factors, and how they're running their business right now will impact that. And the working capital is, so like, here's a couple of the reasons that I am promoting, and I'm curious on how you think about my thinking here. Cause like with my clients, as we're, a lot of them are working on getting out like in front of like a COO, executive CEO or something like that. It's like, okay, well, we want to put in a short-term compensation plan. Not only normalized EBITDA should be part of that, in gross profit, and a couple other growth factors, but working capital is one of the things that I'm a huge proponent of, because as a seller or as an owner operator wants to step back from the operations, Dave, what's the things that are going to impact cash? Well, it's like, well, you got $5 million in receivables and 2 million of them are over 30 days. So other people have your cash, and you have, my buddy was just saying, he's like, yeah, I've got inventory that's 15 years old. It's like, you got inventory that you don't need. And then you're paying your payables in 10 days. So you're like, every month you grow, you're getting further behind. And they do that. I think when you said conservatively, what I see, Dave, it's like, well, I don't want to bother our customers, or like we did the receivable. We don't bug them with receivable collections because they're nice to us. And but what happens is, if we go to sell that business and we hire Prairie Capital Advisors, we have to give $5 million worth of receivables, not free. And we have to give all that inventory. And so not only is it inefficient for cash flow for the current owner, but they get screwed when they go to sell because they can't prove that story of what the normal level is.
Exactly. And so in an ideal world, someone goes through that thought process and process in advance of selling to prove out that this level of working capital actually is an accurate assessment of what it takes to run the business. But that's exactly to my point. I mean, there's a lot of people that, I don't want to say it's lazy accounting, but it's just accounting it's just not a necessity for them in some regards. And so they'll maintain some inventory on the books that's clearly obsolete, or they'll have receivables that are clearly not going to be collected, and it's kind of more of a hope situation, and just cleaning up a lot of that, cleaning up to your point, the timing of paying, payables and collections and everything else, all that plays into that number, and it can come down in a lot of cases to a relatively significant sum. So it's really important for people to take all of that under consideration and to really, objectively look and say, okay, well, if I need to run this business, what's the most efficient way to run this business from a cash collection cycle standpoint? And be honest with it, because you're going to get tested from the buyer.
And not only that, but like what like, and back to your point, it's like, why wait till you sell the freaking company to do this? Like right. And I think about and maybe it's over the last 5 years or so, Dave, since we've known each other with COVID and supply chain issues and inflation and employees and all this stuff, where this all has just risen to the top of a high concern, and the banking and the lending. Cause what ends up happening is, if in that example, we can pull $3 million more in cash into that company, well, if that owner wants to maintain 50 grand a month in free cash flow distributions, there it is. But usually people are like, well, my bank line is tapped. And it's like, well, there's millions of dollars sitting right there if you can build processes around that. And then that's why I suggest not only putting that in place, but then have the CEO do that and have them comped on that. So that way, if you're truly trying to take a step back, so many times, Dave, when I watch these people hire CEOs, they just hire, Dave and I are in sync and we think the same way. Here you go, Dave. And they just hope it works, versus put a metric in place. So that way, if Dave's running my company, I make sure that I get my distribution while the company is still healthy.
Absolutely. And the reality too is that if you're trying to grow and have a significant growth trajectory, having a greater demand on your working capital just locks in even more and more of that free cash flow that you'd normally be generating. So it's important to flush all that out. I mean, having a higher percentage of working capital relative to revenue is just, during a growth period, is just eating up, more and more capital. And it's just, making sure that you have an optimized cash conversion cycle, built into your business so that your working capital maintains its appropriate level is key.
And you hit on something I think is important there too, and why I think how this is easily or more easily digestible is, you said percentage of revenue. Because I think so many times, Dave, a lot of my clients or the people I work with, where I'm used to having $1.5 million in cash in the checking account. I'm used to having $4 million in receivables. And there's this gut version of this where it's well, if you plan on going from 30 million in revenue to 50 million, those numbers are going to change. So there's this weird gut instinct that's in conflict with their goals. And having that shifted as a percentage and managing that percentage is just an easier way of thinking about it.
Oh, agreed. And a lot of times, if people have inefficient working capital, they tend to be into their line, which now not only are they paying interest cost on that, but it reflects the business very differently, to a buyer as far as what the needs are and its ability to even finance a buyout.
So let's thank you, and I think that was helpful, because I know that's one of the core pieces of things that people are working on, that I'm working with is. So then, as we shift over to deal structures, Dave, and the reason I said this before I hit record, is that the reason I have always been a huge proponent of Prairie Capital Advisors, you guys don't care what monetization structure people use: ESOP, management buyouts, private equity, third party. You guys are helping people no matter what. And you have a lens of, how do we match that event with the owner's objectives? And that's where I think, since the day I met you, we've been very aligned on kind of the mission that we're trying to help people on. Any thoughts for the audience, that you just kind of, how you guys approach that marketplace before we jump into some of the deal structures?
Sure. I mean, we're often approached by someone who's looking at an ownership transition, and usually they have an idea of where they want to go. At least they think they have an idea of where they want to go, whether it be, through just selling to a third party, ESOP, management buyout, whatnot. I think, where we really try and add value is sitting down with people and helping them to understand what their hierarchy of needs are. And a lot of times when everyone approaches us, it's all about the dollars. It's okay, I want to get the most money I can out of the business, whatnot. When you start peeling back layers, and talking to business owners, usually there's a lot of different elements that are really critically important to them that don't necessarily, focus solely on price. And it may be, taking care of their employees. It may be that they have immediate cash needs, or they've got some growth desires and a desire to stay tied to the company, whatnot. I mean, there's a whole host of things. A lot of people too. I mean, this has been their baby forever, so it's legacy of the business, and not having their name ripped off the front door, and having the whole culture of the business changed. So for us, it's really getting in and helping people to understand, there are different alternatives that satisfy each of those criteria, but then also helping them to understand, okay, well, what goes in pocket? When we look at the after-tax proceeds that are being received, what goes in your pocket? And how does that relate to satisfying those other needs, the softer needs? And then also it's a question of just the timing of the receipt of those proceeds. I mean, what's their risk profile like for, having something that extends their payment over the course of time? So we really just want to get in and provide someone with kind of a holistic view of talking with them about all the different elements that may impact the business, or, their relationship historically with the business, and really, dig down into that, and then also show them very clear modeling of what all these different avenues mean and what the processes are like in each one of those different scenarios. So our goal in walking into any relationship is all about education. And so the main thing we want to do is limit remorse. And so that we see a lot of cases where there's been seller remorse because people, it didn't work out the way that they hoped it would. In the end, maybe even after they've received their proceeds, things didn't work out, and it's just something that bothers them, and whatnot. In other cases, they just weren't aware of different alternatives that they could have pursued, and they have regret afterwards because they're like, wow, that would have been really neat, and that would have, been a situation that was more satisfying to them. So for us, it's making sure that we have, this education process going very strong up front, and helping to ensure that when they push the go button for us to go and look to start, executing and running a deal, that they have absolute clarity on what the objectives are and why.
Which is where there's been like 100% alignment with you guys at Prairie and me since the day I met you. And what I think about is interesting, is like the education, like, and I think we're like what you're doing, what I'm doing, like in the people listening in, there's like a hierarchy of education, right? Well, it's just like awareness, right? Like, okay, what is going on? What's the what's the market landscape? How do valuations work? What are my goals? And when I think about this, Dave, is like, so that as we continue to build off of what you just said into the deal structures, is like the framework that I'm helping people try to think through is, what do you want out of your time, which is your job, right? Like, I mean, like, because in each exit option, ESOP, private equity, bolt-on versus a platform, versus strategic versus a management buyout, that owner operator's job will be impacted on, and like how the risk, because there's this whole like matching of the payouts with that job and that person, right? And then there's their goals of the legacy and all that. But one of the things that I'm trying to be such an advocate of it, if they know what they want out of their time, then we layer on their free cash flow income. So if it's 250, 500, I don't care what it is, but like they need money every month and every year, hopefully not tied to their labor, right? That's the ultimate goal. And then how that is created is through assets, right? So whether it's real estate or your business, but you're getting distributions, hopefully not tied to your labor. And if they can figure out what that freedom number is with that equation, then we can layer on and say, okay, well, if you got a 2 normalized EBITDA times a 5, that's $10 million. Okay. You got $10 million on the cash flow valuation. Now let's layer that on the options. And like, there's certain implications with every one of those options that you talked about. But if they absolutely need 5 million net, then they could come to you. So let's just maybe take that example and we can use that to kind of thread these conversations or the rest of these options. David, like someone comes to you and says, I got 2 million in normalized EBITDA. I'm quasi in the business. Like I'm maybe the strategist or, whatever it is. And I need 5 million net. even though the company might be enterprise value 10 million, you guys take that education, say like, truly, what are the implications of all of these scenarios? Right. Cause like that right there, I mean, they have to see the numbers. And that's why I love what Prairie does so much, is because you're not jamming them down an ESOP because that's the only way you get, paid, or just down a third party. You're literally looking at the spreads of all of those, saying, how will each one of these deals impact your net proceeds versus over time, and what that means for your job and your control. And so is that helpful? Because like, I mean, I think it's difficult for people to see these components that you and I can see like in our heads.
Sure. No, I think it, but I think one of the biggest maybe hangups that we see with a lot of owner operators is that they view everything as one. And the reality is to your point, there's ownership and there's operations. And the operations being their time and what they want from a job perspective or from an involvement perspective. They're two very different things, and they don't need to be married. There's ways to get liquidity by selling some of the asset that you're talking about, that's helping to produce this cash flow, and to monetize in an immediate sense some of the future cash flow streams there. But it's really important when people are looking through this that they separate those two things, and psychologically they can say, okay, here's my equity ownership and what that means to me personally, but here's what, I mean, maybe they're not ready to retire and they're saying, I still want to be involved. I need to be involved. Like, I can see this through, I love what I do, but I just want to take some chips off the door. There's a whole host of things that we can go through with them to try and figure all that out.
But isn't that the first, it's like when we look at a decision tree, like out of like the 10 years I've been building this material, Dave, it's like, it has continued to be like, that helps people see the matrix. That's the only way I've been trying to describe it, is because like, I mean, what I think my job is with my clients is just help it. Once they understand how all the game is played on this side, I'm just holding their hypocrisy in front of them. Like, here's an example. I hear this probably at least a third of the time. I want more time back. I'm so sick of the grind and eating shit. And it's like, they're talking about their job. And then they're like, well, if I only sell this private equity firm, I get half up front. And then I'm like, they're going to need you specifically to do the work for another 7 years. So literally they're they're conflicting exactly. They're like, because this is my first priority, I want this. And I'm like, literally it's the opposite.
Yeah. And I think the biggest thing that people get into in that is that now you have a new boss.
Right. Yeah. You're not even doing it on your own.
All of a sudden you've got someone that's overseeing you and telling you what's good, what's bad, helping you or not helping you, really taking some of your input, but then making decisions about the business that may or may not be in conflict with what you think is best. So, yeah, it's a tough thing. I mean, there's a lot of good reasons, particularly, age being one of them, or someone that needs capital to really take the business to the next level. You might need to bring in a partner, and that might help you to achieve the end goals. And so it's important to find the right partner in those situations that isn't going to be, dominating the conversation and the strategy and whatnot. But yeah, I mean, there's a lot there, and there's a lot of entrepreneurs who I would say find themselves in a situation where it's untenable once they all of a sudden have a partner, because they've been king for quite some time, and it's like now
one of those tombstones that people can't see that you and I both know is one of those guys, and I talked to him last week. Oh boy. But like, I think to your point, and this is where it's so fascinating, because like, if they come to you and say, okay, and this is where I'm just trying to be the advocate of the complete clarity. So like, my goal is to have a more efficient market for these. We have the same mission, less remorse. Everybody deserves to get the value that they created. But it's like, if we are trying to optimize time, like half the time, or that's not half the time, they called this morning, the guy, he could sell his company for 25 million. Half of it would come up front. The other half would be rolled equity, and he wants time. And I was like, dude, like, you have to do what you need to do no matter what, whether it's you by yourself or the person that like, and I said, the only reason you should take the money is because $12 million, maybe call it 7 net, is enough for you to give the middle finger when the whole thing doesn't work out because you're burnt out. But like, don't pretend that you're going to get all of it if you're already burnt out and it's going to take you 8 years to get there. And so it's just this, like, you have to do the same amount of work no matter what.
Yeah. And that money is at risk with someone else having the ownership. And so you're not going to want to, even though you're burnt out, you're not going to want to step away because you still have half of your asset in that business that's at risk. So yeah, it's a difficult thing. And we've seen plenty of cases where people have done this, it's been extremely successful for them going through a process like that. But we see a lot of people who maybe are kidding themselves a little bit as far as their desire to keep driving when they've got someone who has now made a significant investment and needs to show a return, and they're going to be the time that they're requiring of that party. It's just like to your point, it's in conflict.
Well, and this is where I think what we're both trying to do is say, like, because here's how I describe these different buyers, these different categories: ESOP, private equity, third party, anybody who that buys a company. They're neutral. It's like if this pen was a knife, the knife is not good or bad. It's the intent behind it. And then we need to match the intent and the expectations with the outcome. And that's all we're trying to do, because it's not good or bad. It's just a mismatch of all these expectations. And so through understanding what do we want out of our job and the legacy of the business, how much do we need net at closing? And then how much are we willing to take over time, and how do all those match together? Then you can look at, you being Prairie can say, okay, well, here's a couple different options, right? And how each of these options or buyers could impact your net proceeds and how much you take over time and your job. So maybe we can talk through, like, when I think about, because like one of my clients sent me, it was a $22 million LOI. And I'm like, they've done no due diligence. They literally sent you a piece of paper, which means they know nothing about your business. And like I said, the chances you get all that money up front, and he's already got it spent. I'm going to pay off this. I'm going to do this. I'm going to give this to that investor. I'm like, no. Stop. And so we have cash at closing. We have, some sort of parked escrow, seller's notes, earnouts, rolled equity, and warrants, and all these different tools are for buyers' ability to match that risk and return. So I don't know, how do you want to approach this? Because we can take it by different types of buyers or how each buyer handles these, but I think it's important for them, the people listening, to understand how these mechanisms are used to structure the deal to get their return. And there's different types that I think are more popular in different exit options. So any thoughts on how you want to unpack this?
Sure. I think there's just a number of different ways that you can go through this. Maybe we'll start with the cleanest. So let's say someone is burnt out. They're ready to go. They want to hit the beach, whatnot. Certainly, there's a lot. Rolling equity is not going to be a great option. Doing an ESOP is not going to be a great option because both of them have time in order to recapture.
Is the assumption that they're burnt out and they have a significant role in the business?
Well, yeah, in that case, yeah, that they're going to have to do a roll into the business. So, really what we're looking at is for a buyer, and in those cases too, it's important that they have a strong second. So one of the problems we have on the front end is that a lot of times these owner operators, they're close to the vest on a lot of things, and there's not someone that's really able to go and replace them. And I think the mistake people make is thinking that whoever the buyer is going to have someone parachute in and take over that role. And that's risk to the buyer. So if there's someone that's already in the business and being able to do it, it gives them the cleanest exit. In which case, we're looking to negotiate, with a strategic or a private equity firm to go and provide, as much cash up front deal as possible. It can be an all cash deal, maybe just some escrows. So the only money that they're waiting on is escrowed money, which is, protecting against certain things that they've repped. So, those are the cleanest, deals. And sometimes when you're asking for a deal like that, you're going to see a little bit of degradation in price because the buyer is assuming all the risk, right? They're basically saying, we're going to take this over. You're going to be gone in short order. We're assuming all the risk. Now, normally they'll have the seller stay on for 12 to 24 months. I would say any of the 24 months one, it's very rare to see an owner who's already kind of checked out staying on for the entire 24 because.
Well, David, this example is my father and I. We were doing 19 million when we sold, and we had 90 employees, and they took the customer contracts, they took the skeleton crew. There was all the same ERP systems, the same systems. And it was just, take a CSV file of the customers, upload it to their ERP. I mean, like, there was the ability to generate that return super fast because we got it at the company.
Exactly. Well, and they obviously had enough of what they needed to go and plug it in. That sometimes it takes maybe a president that comes along with it that at least helps to bridge their ability to do so. But other times, there's certain businesses you can just plop right in, and it's as long as you have managers.
It was the same but that's why I think it's such a unique experience and not very normal, is because both Canon sellers, both did managed IT services, both with automate the ERP system, compensation plans are the same. It was like we literally restickered thousands and thousands and thousands of copiers, and that was about it. And so we got the deal done in 2 weeks without an investment banker. And the reason I'm doing this for 10 years is because it didn't go the way I wanted it to. So I'm not saying that was perfect, but I'm saying, to your point, that's how we got most of the cash up front. And then there was some escrow and, some different things going on because of contracts and, other things, but it is not awesome. And it's not normal either, I would say.
Agreed. Those are special situations, and we have people that are just like, I just want out, and we'll work on those type of deals for them. Again, it generally comes with a little bit of degradation of price, but for more normal situations, we'll have, particularly depending on if there's a lot of growth in the business, or there's some things that are on the horizon that, investments that have been made in equipment or in personnel that haven't yet yielded, the results that are expected from them. You'll also have cases where there's earnouts that go along with that as well. And so there's cases where, maybe someone's expectation is that they're going to get 25 million out of the deal, but they're getting 20 up front with $5 million worth of an earnout. Well, certainly as a seller, you want to stick around during whatever that earnout period is, at the very least, and look to drive this, because you're still owed a good amount of money, and you don't want to put that in just the hands of someone, without your oversight.
Can we double click on the earnout? Because I think this, and I know you said, and I think what we could do here, Dave, is, we're talking about kind of like the cleanest sale. And then I think maybe what I'm thinking out loud, but what if we kind of go through the different deal structures with this clean sale, and then we could then stack on, once we cover these topics, on top of ESOPs versus maybe more complicated private equity or management buyout. But I think we could follow through with these concepts. So you're getting cash up front, some escrow. When you were saying reps, it could be like employment or contracts or some things that they just have to make sure come to fruition. But escrow is different than an earnout, and then rolled equity and seller's notes. So maybe kind of walk through the stack of different options and why are the buyer doing those things, and how did that impact, the kind of the matchmaking of the deal?
Sure. The buyer, in the case of our first situation, is they're buying an income stream. They bought into it. They've priced it as such. They go. When there's the potential for growth in particular, or there's something that's contractually tied that maybe as an at-risk contract, a lot of people will look to put in an earnout. And what this effectively helps is, it helps them to ensure that that stuff comes to fruition, or they're not going to have to pay for it. So there's two alternatives. You could say, we're going to pay for it day one, but they're going to discount what they view as a component at risk pretty heavily, to where you're not really getting paid what you think that element is worth. So
is that done through the weighted average cost of capital, where they're discounting that net present value essentially, by a lot? Or is it just...
Yeah, they're changing the risk profile. So the company specific risk they put on that would just be greater. And sometimes it can just be that sliver that they're discounting more heavily. But I think for a lot of people, they're like, hey, I want to see this through to fruition. I know this is going to succeed. That's why I made the investment, whatnot. They'll get their payment, their 20 million for the core business, which the buyer has bought into, and then they'll be at risk for the other 5 million in that instance. So, and that's going to be driven off of just hitting specific targets, whether it be a sales target, EBITDA target, whatnot, as far as the growth of that element, and then they'll receive additional proceeds.
Well, and that earnout, and this is where I think I can't even imagine the amount of complications you guys have trying to explain the different factors of these in the middle of the deals, because again, none of these structures are good or bad. It's just about matching capital expectations together. And like with an earnout, Dave, I mean, I years ago created I think I titled one of the podcasts Earnout Burnout. And it goes back to like, what's the intent behind that structure? And like, and not only that, but you said they're measurable things. And like, I literally have a personal story where, I was talking to someone and I was like, "Oh, how's it going so far?" He's like, "Well, shitty, because this deal, that the second bolt on, that cost of that acquisition it hits my P&L and I'm not getting any of my earnout now." And I'm like, "Oh, that sucks." And so like making sure that earnout, because like they don't control it anymore, right? So like, and Bobby Martin was a guy I had on my podcast, and there was he sold, it was like you're probably familiar with his software now. He sold to like Moody's or something like that, but all of his salespeople that were like that, all the sales numbers that were driven off of the sales numbers were manageable in his current operations. But then when he sold, all of his salespeople got another 40 different products to sell. And then all of a sudden he didn't hit it. So like when it's pure, I think it works for the right reasons. Like you were talking about, like how can you mitigate or how can you optimize that earnout structure in a way that is good for both parties?
Well, we want to define that as clearly as we can up front, and we want to isolate it to the core business operation, because you're exactly right. I mean, they have an incentive to, say they're even in the same line of business, they have an incentive to recognize revenue in a different section of their business, or pull resources that are drawing away from this. So we want to make sure that, as this is defined, that it's defined as clearly as it can possibly be, and is at least manipulatable as it can be, because that's really what you've got to protect against, because that's a real risk. And I guess back to the question of why do people put these in place? I mean, people put them in place because there's a difference of opinion generally with regards to the risk or even the potential of achieving these results. And so it's a matter of increasing purchase price. So if the buyer's saying, we'll pay you 20 for this, and you're saying, well, wait a minute, at 20, now you're paying me 5 times EBITDA rather than the 6.5 we've been talking about. They're like, well, you haven't achieved that, and we don't see you achieving that. Well, you need to put that at risk. And for people that have high levels of confidence in their ability to achieve those results, it makes sense to do an earnout, because this is all going to, they'll increase their payout, whatnot. But it's also a means for buyers to not have to come up with the capital today. So, one, they have free cash flow that can offset that in the future, but even more so, they don't have the carrying cost of the interest expense for debt that they would take on in order to buy out that last $5 million. They get to see that play out over 12 or 24 months and then pay it out. So, it works on both sides, potentially. If somebody doesn't want it, it doesn't have to be there. But again, you're going to see a reduction in purchase price. But if you're really looking at driving to a number, and we have a lot of sellers that, they'll just say, they'll get a number stuck in their head and they're saying, I need X. Well, you're not going to get X without an earnout, but with an earnout, you'll get X. And the question is, do you really believe in what you're presenting from that earnout component? And if they do, they're going to buy into the earnout. So,
as long as then it's non-manipulative.
Exactly.
KPIs. And I think this is where, like, again, back to your and I's mission is just education helps clarify intents. So you're matching up those intents of like the intent of the seller and the intent of the buyer, because like at the end of the day, from a buyer's perspective, they can raise senior lending or senior debt, mezz financing debt. They can do, then they have to bridge that valuation. If they're going to go try and buy something for 25 million and they can't raise all the money, they don't have enough equity, or it eats into their rate of return, they're going to have to figure out how to seller's financing or earnout or something to bridge that $20 to $25 million gap, that in order to get the deal done. I mean, like, and that's where I think it's just, I find it very fascinating, Dave, is like, as I've been doing this more and more, like thinking about this from the buyer's perspective, all the sellers end up getting it, because like they would do the same exact thing. Right. So then it's just trying to figure out, okay, what is the expectations of that X 5 million? And like, to your point, you're not going to, like I was, and you're not going to bamboozle or get someone over a buyer. Like, you know what I mean? Like if your projections are crap, like you're going to be held holding that bag anyways. So I think it's just kind of level setting the marketplace.
No, it is. And I think that's one of the benefits of having an investment banker in the deal is, one, you look for these things that can be, and you've seen manipulated, whether it be a working capital post discussion that someone doesn't understand. Again, they look at the headline number and they don't understand they've just lost $1 million on the deal because of that component, or whether it be an earnout that's structured in a manner that's easy to manipulate, that allows someone to take that over and not have to really pay for it. Along with the fact that, from the buyer's perspective, the seller's perspective, them directly having those conversations can become very emotional, and it can destroy something that's going to be, when there's a business combination, you need to get along. And so having someone in the middle that is hearing this, digesting it, and being able to communicate it, with intelligence and with context back to the seller when this is in front of them, to give them, again, comfort in proceeding, is a really important part of our job.
Well, and in your job, it's like I've been using this example where, like, I'm holding up my iPhone right now, and like as we continue the conversation about deal structures and buyers, like, I mean, what I found is the biggest problem in the marketplace is, how do you and I trade this iPhone back and forth if we do not have any understanding of fair value? Like, if you and the way I think about like ESOP versus private equity versus all this stuff, when people don't understand the valuation metrics of normalized EBITDA, the multiple, working capital, and they don't understand deal structures, you and I, like, you might think this is worth $100,000, I might think it's worth 1,000. Yet you and I are arguing over Droid versus iPhone. So how do we even have the Droid versus iPhone discussion when we have no idea and any agreement on the valuation of the actual assets? So, like, understanding the valuation metrics and the deal structures is understanding fair value. And so when I think about an investment banker, and one of those tombstones that's behind me, he was going to have his brother who was an attorney, or some friend that was an attorney. I'm like, do they even know what net working capital adjustments are? And he's like, what? I'm like, exactly. like that's part of trading fair value, is knowing what normal is in the marketplace. And as a owner operator, you just don't know what those things are. Like, you're trying to trade fair value and be treated fairly, but it's difficult if you don't know what fair is.
Absolutely. I mean, valuation is critical. And quite honestly, almost everyone that you're ever going to run into in this process, I mean, I shouldn't say it. We have some people who are pretty well versed in it, but I think for most, they're sitting there and looking and saying, okay, well, I know someone in my industry that sold for X, and we're better than them. Like, everyone is proud of what they built, and so they think that they're worth the premium of things. And we have cases where people will even be wrong because they're even better than what their competitor was. But there's a lot of cases where the people that they're comparing themselves to are the best in the industry, and that's the multiple that they're looking to get. And it's important to go through a valuation process to help them to understand why that's not the case, or why they're different from the other party. Because again, you'll just ruin a discussion with a buyer if your expectations are way out of line with what market would be for your enterprise.
Well, and then because then I think about, okay, so continuing with the deal structure side is like, if we're agreeing on the normalized EBITDA to the multiple working capital, and then we say, well, we have to bridge this, and back to your $25 million, we have to bridge that $5 million gap. What are different ways we can do that? And we have to agree on what the future could hold and what our roles and responsibilities are to generate that free cash flow to yield that extra. So we talked about earnouts, and then maybe speak about seller's notes and rolled equity, and like how those are different ways of also bridging that gap, and then how that helps the buyer get a deal done.
Sure. Certainly, I'll start with seller notes because that's the easiest. And generally speaking, that's a situation where maybe a buyer doesn't have all the capital necessary to buy out the firm. They see the value in this, but their balance sheet and the balance sheet of the company that they're acquiring doesn't support the level of capital that's needed in this deal. So, they'll basically have the seller take on a note. Now, the good news for the seller is that while their note is going to be subordinate to the senior capital that's brought into the deal, they're senior to the buyers, because the buyers now own equity. So they're taking a senior position. It's a position that's, well, it's at risk. It's at risk in a very different way. It's on risk in the ability of the company to pay off their debt over the course of time at a fixed rate. So a much safer position. It gives someone the ability to capture value and if the company goes south and ends up in bankruptcy, all those things. Now, We see some of those. I mean, usually those will be on, on private equity buyers that are fundless. So there's some people out there that try and do private equity deals that don't have a dedicated fund, and so they go out and try and raise capital for that specific deal, and they may end up short a little bit of capital, and so.
Or all you have to do is go on my Twitter X feed, and all the people promoting buying companies with zero money down and seller finance.
Yep.
It's super easy. Passive cash flow, Dave. It's really easy to own a company and have everybody foot the bill for it.
Yeah, absolutely. I mean, well, those guys, they're not really putting in their own capital at risk. So it's like, hey, I'll go and pull this together. I'll have you effectively take a note that acts as my equity investment, and I'll try and work my way out of it. So it's a little different model. We don't see a whole lot of those, but we do see a whole lot more of the separate side, which is the rolled equity. So, for a lot of companies, if they are short of capital, and there is an expectation, say particularly in private equity, when they're looking at turning a company in 3 to 5 years after owning it, maybe they'll buy out, they'll bring 65 or 70% of the equity to the table, and they'll have the seller roll 30% of their equity into the deal. That can be for a variety, or it can be because they're short of capital, but also it's with the case where someone's so critically important to the organization that they want to get them tied in. They see a lot of value to having these people stay around the company and for their interests to be aligned and not simply to be a W-2 employee. So it's a chance for them to say, hey, you can get say someone needs 20 million today. You can get your 20 million out today. We're going to roll 5, and we have an expectation based on our exit that 5 is going to be worth another 20 in 5 years. So now they're speaking to people as if this is going to be a $40 million exit over the course of 5 years. If someone's got the time, if they've got the energy and want to, and the company needs capital and they believe in the vision of what's being bought into, it can be a great second bite of the apple in those situations, and one that has a whole lot more value embedded in it. So
if that intent that you described is the intent, right? Which is there's upside, someone maybe wants to participate in the operations to get that 5 to 20. And but I think, back to the value of the role that you play is, what if the buyer just doesn't have the equity? And again, when you say they bring in 70% equity, they're doing that through a combination of their fund and debt that they raised. So the way that the PE firms increase their multiple and decrease their weighted average cost of capital is saddling that thing with debt, because the debt reduces the multiple or reduces the WACC. So what happens is, this is literally, I've got 6 different examples, Dave, in the last month about this shit, and it's ridiculous. And again, it's not everybody. It's just we need to be aware, and I want to keep telling these stories. Is PE firm comes on, says, okay, we're going to saddle this thing with debt. So therefore, we reduce our weighted average cost of capital as much as possible. Oh, and by the way, we have no free cash flow anymore to reinvest into the company. So that $5 million you rolled, good luck hitting that, because we can't hire anybody. The guy I'm talking about, I was like, okay. I'm like, do you still have your AS400? He's like, yep. We've been paying Deloitte $90,000 a week for a bunch of 25-year-olds, $1,000 an hour who don't know shit. And so $90,000 a week, still have the AS400. And I'm like, oh my God, what a disaster. And they're just lighting money on fire because they're all ad backs and they can't do anything that you're talking about. But yet there's this paper rolled equity that's sitting on the cap table. And we were talking about, I was like, we were talking about getting it back. And he was asking for it as a written down. Just give me a third of it. I know that this thing is not worth what we thought it was going to be worth. Well, when I was like, and they wouldn't. And I said, do you want to know why? As I said, because the PE firm would have to admit to their investors that if you're all of a sudden written down, the whole thing has to be written down.
Yeah.
And so my point is, what I'm watching is, because the interest rates are higher, there's more free cash flow going to debt and interest, but they still have to hit their 20% IRR. So then all these assumptions are off the freaking charts. I don't know. And again, these are all anecdotal stories, Dave, and you see way more deals than I do, but I'm just trying to make sure that what are the assumptions that have to be executed to get the rolled equity or the earnout or even the seller's note? Because these assumptions are the IRR still has to be hit.
No, it does. And to your point, I mean, there are no guarantees. And I think a lot of people, when they go into this, they're like, oh, these guys know exactly what they're doing, whatnot. But if they look at private equity investments and the success of private equity investments, I mean, most of the return in private equity is predicated on a few home runs, and a lot of businesses in that same pool that fail or just tread water, and maybe they get out at even.
And how many of those home runs realistically were stacking normalized EBITDA on top of each other, multiple accretion and arbitrage, and then lifted off again? I mean, how many were value creation versus free cash flow value creation versus loaded up and pass it on? And I'm not trying to be cynical here, Dave, and I'm honest. It's just I'm sick and tired of hearing these stories of people getting hosed.
Yeah, no. I'm with you, and it's something to look out for. But again, you've got to find the right partners. You've got to make sure that your position's protected, that you understand their commitment. Because to your point, if they run this thing and the company has no ability to grow and expand because of how they've structured the deal, well, then your rolled equity is just going to sit and tread water at best. I mean, you need to have investment, and so there's a lot of companies that are continuing to look at invest, and they'll, they've got good wherewithal, they've got good strategic guys that are on board that are seeing this, and there's certainly a lot of success stories, but to your point too, there's a whole lot of stories where people are, it doesn't turn out the way that they thought or hoped, and I think that their own mindset was that this was more of a sure thing than it actually is.
Well, and don't you think that then it continues to go back to, and again, I'm really trying to be careful where I'm not just cynical, because I'm an opportunistic guy, but if you and I were trying to get a deal done, the way I think about this, and maybe we can get this to help us shift to like the different types of buyers, because different types of buyers have different types of expectations based on the new shareholders, right? But like if you and I were if we were in the situation that we were just talking about, we'd sit down and say like, how are we going to generate that growth, right? Because like if the seller who knows that industry for 30, 40 years thinks it's bullshit, you add the partner, the new debt and all this stuff, like, well, now it's even more unobtainable, yet you have such need for that rolled equity or seller's note. And like, so I think it's just like sitting down and going, what assumptions are actually being taken into consideration for all of this to come to fruition? Because I really believe that between like a role like you as an investment banker and that seller, like, is it achievable or not? Right? Like, let's just deal with reality. Then it's like, hey, like this is 80% chance of hitting it. Well, great. Let's both share in the risk then, right? I mean, it just seems more practical if people are not trying to one up or trying to get something over on each other.
No, agreed. I mean, but again, it comes down to education. It comes down to doing your due diligence and making sure that you understand the risk profile of what you're running into. Because, I mean, it can pay off. And we've seen plenty of cases where people have been paid off handsomely for rolling equity. I mean, so I don't want to pretend like this isn't the thing, but there's certainly a number of cases where, it's just, it hasn't panned out and someone was relying on that money mentally, and it's just, they're not controlling the company anymore either. So it just has some limited focus. But there's a lot of people who, for the very right reasons, enter into those situations and, see it through and have the right partner and have exceptional returns. So,
well, that second bite of the apple could, like you said, if it's done the right way, could very well be the same amount of money as the first tranche of the closing, which is great, which is great as long as the expectations are all aligned. But what here, as we move on to like how ESOPs, and you and I've done a very extensive ESOP mini series. So like I'll link back to that, Dave, as far as like, the different like very detailed warrants versus sellers notes, all that kind of stuff. But I think what's very fascinating with my clients and my audience is like the stuff that they're hesitating to do because it's either takes time or takes reinvestment. They're going to have to do it anyways almost every single time if they want the valuation. And so like, that's the irony behind this. And so if they're going to do it, so here, I don't want to tee up to the ESOP conversation, but so I was sitting down with one of my clients and bought the business, bought a couple other businesses since. He's like around my age, Dave. And he'll probably do $3 million in normalized EBITDA this year. And he wants to sell to private equity. I'm like, fine, like totally fine. I just don't care as long as you get what you want. My job is to make sure you fully understand all this stuff. And I was like, so I play the role of the potential buyer. I'm like the board buyer. Like, okay, answer me all these questions. How is your sales and marketing leading it in your client acquisition costs, getting into your revenue GLs? What's your profit margin on commercial versus residential? How does that roll into then your overhead and their free cash flow, your working capital? And he can't answer me, obviously. And I was like, that's where all your stress is, by the way, which is also why you want to sell. And I said, the moment you are able to answer all that stuff and hire a COO that is tied to all that stuff is the moment you can get max value, and also the moment you don't want to sell. But if there's a monetization event, and here's what I'm really trying to push him to think about, because PE might actually be a great opportunity for him in his space. He's in like the services space and some of the industries that are hot right now. But based on his needs, I mean, it's literally like what was it? Because he's got his debt. I think it was like 7.5 million net is what he wants. So it's not outrageous for the normalized EBITDA, the growth and all that stuff. And I was like, you got to look at an ESOP, because I said, ESOPs are your way where like you could get that potentially up front, and then there's no taxes that frees up cash flow for the sellers. So like maybe kind of use that as a bridge off of like kind of comparing those two and using my example, and he'll be listening to this. So like, because he does all that hard work. I mean, like that is going to help the ESOP.
No, agreed. And taking one step back to what you were saying too. I mean, as you're unable to answer all these questions, every one of those questions you're not able to answer effectively is increasing the risk profile that the buyer is assessing to the business. So, again, to your point, it's not until you're able to answer all those questions that you're able to maximize that, because you've reduced the perceived risk on the business from the buyer. With an ESOP, I think we talked about getting all your cash effectively up front. We've talked about the earnout, which is basically getting most of your cash up front and then having maybe a 24-month period where you're waiting for some. Talked about a rollover, which is getting a good chunk of your cash up front and then being tied down probably for anywhere between 3 and 7 years. An ESOP is a little bit different animal in that, it's an animal where you're going to continue to still be in control of the business from an operational perspective. You don't have ownership control, but there's no one new coming in telling you how to manage the business. So it's a means of transitioning the business in a very friendly and controllable way, because basically you're selling the company to the employees under ERISA, which is effectively makes for a tax advantaged management buyout. So with an ESOP, because you're using just the company and the company's assets in order to create any liquidity, there's a limited amount of liquidity that you can get up front. And I'd say it's usually between 20 and 50% of the value of the business you can probably get up front. The rest of it is going to be held in a seller note.
So should we take that $20 million example? So let's say they get 10 million of that enterprise value up front. And then they were trying to shoot for, and I don't know if I'm stretching here with the example, let's say they're trying to shoot for that 25, but maybe that seller's note could only be 10. And then there's like, I don't know, just play around with that $20 million hypothetical.
So say you get $10 million up front, and mind you, ESOPs buy stock, they don't buy assets, so you actually get capital gains on that without having any recapture and whatnot.
And then the 1042 potential, I'll put that in the which is like a 1031 roller, but that we don't have to get into that, Dave. I'll put the links to this in the show notes.
Sure, but yeah, there is a potential that you don't pay any capital gains on that through the 1042 as you're discussing. But so say you get your $10 million up front, then you end up holding a seller note for, let's say it's a 10-year period for that additional $10 million. Now you'd say, well, why would I do this? I've got to wait an extended period of time for my capital and whatnot. Well, what happens in 100% ESOP, if it's an S corporation, so you switch to an S corporation usually after doing an ESOP, I'll just use that as its cleanest example. 100% S corporation ESOP doesn't pay tax. So all the money that the seller used to have to pay, either at the corporate level or at the individual level, to the government on taxes for earnings that were made by the company, now is able to pay back debt service. So ESOPs are able to get out of their debt service much more rapidly than let's say a management buyout, which is using after-tax proceeds to pay back the debt. So the government is effectively picking up a significant portion of your debt service. So not only can the senior debt be paid back more rapidly, because let's say you were paying $1 million in taxes every year. Now that $1 million is able to pay off your senior debt in addition to the balance of your free cash flow.
Which Dave, like, I mean, and just using that as an example, that $1 million, if you're paying those taxes in the, whatever tax structure the PE or strategic buyer or even management buyout has, that $1 million in taxes impacts the free cash flow and the ability to pay a purchase price anyway. So therefore, all those deal structures we're talking about are ways of, like, they'll spawn from the inability to service that debt, which $1 million in free cash flow to service more debt is just, so there's this ability to bridge that gap in a very fascinating way.
Oh, absolutely. And so, the valuation is negotiated with a trustee. So I didn't mention that, but so you need to hire a trustee, an independent trustee, to negotiate the purchase price on the deal. But in this case, let's say it goes to 20. What I would say would be the most common situation is that while you have a 10-year note, the reality is that because of this enhancement, because of not paying taxes, you're likely able to go back to the bank within 5 years and take out the balance of the note. So someone's really waiting 5 years to receive their proceeds. And they don't pay any tax on those proceeds until they're received. So we get installment treatment on the notes. So, while you've got $10 million waiting out there, you're earning a subordinated debt interest rate on a pre-tax amount. So for someone that's looking at, say, working for another 5 or 6 years when they sell the company to an ESOP, they know not only are they going to be gaining their income from operations for their normal wages, but they're also going to be getting this interest from their note.
What would that be? Let's just use the $10 million and like, maybe you were going to go back and restate that because it's so freaking awesome. And every time I talk to you, you're like, they're making that interest, that mezz financing rate on pre-tax dollars.
Yeah.
Right. So
getting a 40% enhancement on an interest rate. So if someone were to sell their business today in our initial example, just for all cash, and they're looking to create income, they're going to pay all their taxes. And if it was an asset sale, they're going to pay, more of their taxes. And then they're going to try and say, okay, well, now I walked away with, on a $25 million deal, maybe I walk away with, $14 million or so.
And that's assuming you get the earnout if the $5 million is the earnout, right?
Yeah.
And then because that would still be over 5 years. Yeah.
So like now I'm trying to create an income stream for myself. I'll go out and buy bonds, which are yielding, call it 5%. With the ESOP portion, the $10 million that you have out there, you're going to be getting, a double-digit rate of return on a pre-tax number. So say it was an 11% return on that note. It's actually more like a 14% return because it's on pre-tax money. You'd have to replicate a 14% return on your bond purchases in order to achieve the same result. So there's a lot of different benefits. So there's a lot of people who initially in ESOPs are thinking, well, I don't know about this seller note. Maybe, I'd rather get my money all up front. The funny thing is usually a year after they've had these, they're like, I don't want these notes to go away. They can't replicate them anywhere else. So it's like, I can't get a return like this anywhere else. And it's a return in a business that's predicated on the success of a business that I already understand and believe in.
Yeah, I'm not paying any taxes. I'm still let's say there's still the CEO making 300. So they're still controlling the operations. They're making 300 of the salary. And correct me if I'm wrong, but they also can vest back in, right? Into the ESOP.
If they don't take 1042, they can participate in the ESOP.
Okay, so let's assume they don't take the 1042, but they can vest back in. And on that, so let's say it's 11% at 10 million bucks. So what do you got there? Then 100. What the hell is that? Is that 110 grand? Then,
Yeah.
So you get 100.
No.
No, I'm sorry. 1.1. Yeah. Like so they're making 1.1 million. Is that a year then?
Yeah. Well, I mean,
and it's not taxed because it's taxed because it's based on an installment.
Well, no, the interest is taxed. Interest
But
is
like, but when they're getting that,
ordinary income.
so when they're getting that, because they're paying their senior lender, right? So they're still paying that senior note every year. Are they getting paid just the interest then?
They're just getting paid the interest usually.
And that interest is taxed. So
Yeah.
that 1.1 would be taxed at,
Yeah.
okay.
And then the 10 million as it's paid off is capital gains at the time it's received. So you're able to spread your capital gains tax over the course of a longer period of time. But again, there's a huge benefit from a post-transaction return standpoint in having a pre-tax note that is earning double-digit returns in a company that no longer pays tax. So there's a lot of benefits. And so again, that's something where we want to map out. Maybe there is a strategic that's interested in buying a company, and they're paying maybe they're paying 28 million, and the ESOP can only pay 25. And people say, well, I can get 3 more million by selling to the strategic. Well, depending on if it's an asset sale, which it likely is, there's probably some greater tax on the onset. And the question is what's your net worth going to be like over the course of, say, 5 years, 10 years from now? If you buy a diversified pool of assets after you sell to the strategic versus if you go the ESOP route and have those dynamics, it blends to where they're even, more or less.
Right. And in both those situations, you most likely have the same freaking job anyways, right? Like, and like one of them, you've got a boss that's going to be breathing down your throat because their internal rate of return and their timeline and their debt structure is going to be impacting everything. Right. And even back to the ESOP, Dave, like when we would talk about that 11% on that 10 million bucks, so the 1.1 can be separated into warrants, which could act as rolled equity, right? So if they really are bullish on the upside and they don't just want the seller's note, they could take some of that 1.1 and allocate it to essentially stock options for the future. We don't have to get into that right now, but like there's a different way of combining all of that, right?
Yeah, in order to cash flow the deal, a lot of times people will go for warrants, and they just like the upside potential of having that piece. But I think the other thing is from an estate planning standpoint, when somebody does do warrants, and I know we're going into a pretty deep level here, but when somebody does take warrants, those warrants are worth very little at the time of the deal, and they're able to be gifted. So if you do have estate planning issues, it's an incredible tool to pass along wealth, kind of getting around a lot of some of the estate issues that you may be having. Well, so maybe these warrants are going to be worth 8 million in the future, but immediately after the deal, they're worth 250,000. You're able to gift $250,000 worth of assets out of your estate, and they grow. They balloon. Yeah, and so then you don't have to deal with the estate planning aspects of that.
Well, and which is so important because and I've always said, Dave, and like as I've tried to just beat into my clients and audience head is like, what are we trying to accomplish? You're going to have, like in both those scenarios, you're most likely operationally going to have to execute the same freaking strategy anyways, right? So it's like, if you're like, you truly have to build out, like if you're trying to get the investments, the return on the investments, the machinery or the equipment or the whatever, you're going to have to realize that growth potential. And if you can describe that growth potential, back to my client's example, the moment that you're able to describe to me exactly where you're going to go this year and in the next 4 or 5 years, build out the 3-statement model, have the value growth plan in place, understanding your working capital, distributions, and taxes, and have that projected out and can answer me all these questions, ESOP private equity, you're going to have to do this anyways. Right. So like, and then what I say, like, there's very, very specific reasons economically or macroeconomic, like, you're scared of OpenAI and Amazon and Google destroying your e-commerce business or what? Like, sure, like there's a higher, like, but most likely the buyers are going to see that risk too, right? So like, I'm always trying to help people, like the risk that you perceive or the risk that everybody else is probably perceiving anyways. So like, we're just trying to match this all up. And like, if we go through that example again, I have said to people, I'm like, if you build out that whole plan, not to say you have to do the ESOP, but like, you're going to have to operationally probably do something similar. If you take the 25 million, let's say it was even 22 million versus 28 or 23 versus 28. So it's a $5 million spread, net proceeds over those 4 or 5 years. I'd almost bank on the ESOP almost every time.
Yeah. I mean, it depends. I mean, and mind you too, the one thing that needs to be taken into consideration there is if you get all your cash up front, you're going to have it invested over those 5 years. So you're making a return on the investment that you make with your proceeds if you received all your proceeds up front. But again, it warrants looking at it. And the one thing I think that's important to note too, because if anyone's thinking about this, I just want to cover it. Again, an ESOP, you're leveraging the heck out of the business. We talked about private equity leveraging the heck out of the business. And in your one case where they didn't have enough capital to continue to grow it, you need to be thoughtful in structuring an ESOP, because if you believe in that there's growth potential and you're going to need capital for that, you want to make sure that you structure the ESOP to where you have available capital to achieve those growth objectives and not just getting you paid back as rapidly as possible.
Well, and doesn't the trustee and Prairie Capital Advisors, I mean, that's where you're helping out in the feasibility study, making sure all that's matched up with the growth rate and stuff like that. And the free cash flow generated from a lack of taxes usually helps bridge that gap in a way more advantageous way, is what I've seen.
It does. I mean, you will see some people though that structure deals solely for the seller just to get their money out, which again can be a little short-sighted. Yeah. But it's and they're not right for everyone. I mean, there's again, we have all these different products because we want people to understand their alternatives and make sure that they find the right path. But it's something that I think from a broader perspective is like the least known avenue of exiting. And we just see a tremendous amount of people who've found them to be extremely helpful in exactly what they wanted from an exit standpoint from their business.
I mean, back to what you guys help people do is like, depending on what you want, there is like, I think it's a good, as we're coming to a close here, like why I like what Prairie does and what I'm constantly trying to advocate for is there's no right or wrong answer as long as someone knows what they want. And if people can fluidly have this conversation with you and I that we're having, and they understand what the forecast and the operational strategies are, like you're just matching up intentions and expectations is all people are doing. Like, I mean, I don't know if you ever heard of Ron Elvesteffer. He's on my friend Rob Daniels' board. He was at least not Daniels, Rob Dubé's board. He did 3 private equity sales. He took the company from 12 million to like 400 million in the last 15 years. He went like 3 private equity companies, not like, I mean, like, so he wanted the rapid growth and he's been doing it. And so like there's that, or there's, I mean, how many ESOP stories that we hear that are good or bad. And so I think what happens is, Dave, it's like in the middle market without podcasts like this, it's people are just, victim to their friends' conversation at the trade association or the Vistage peer group, and everybody picks the one story. It's like, does anybody tell you that they lost in pull tabs or at the casino? Of course not. And I just think it's like, and that what happens is then there's no relativity for people to grab onto and go like, okay, like what's really going on behind the scenes?
Sure. No, and that's a big part of it. And like I said, obviously we're very well versed in corporate finance, but that's half of our job. The other half of our job we view as corporate psychology. And it's helping people to understand exactly what you're talking about and what you're really focused on, which is, giving people tools and information in order to make the best decision possible. And, it's critical. And there's a lack of knowledge in certain means of selling a business or certain strategies and whatnot. And sometimes, and there's a whole lot of people out there that only do like, they sell one product. So, say they sell ESOPs, everything looks like it should be an ESOP, no matter what they run into, or someone only is, an M&A, third-party sale professional, they go and do that. Our goal is to just make sure that we open everyone's eyes to the potential and opportunities. And one thing I didn't talk about is that for all these, there's different time frames for someone who wants to exit. And so you might want to retire when you're 65. Well, if that's the case, depending on which one of these different strategies you want to pursue, you're going to want to potentially start much sooner than the date that you're going to look to retire. So it's.
I mean, you're talking about job. I just want to keep, because this is what I will always do now. I'm like, it's a tick of mine. Retire from your operator job, but like the capital and when you get the capital back is also different, right? Because you might want to retire at 65, but you're willing to let the capital and the inflows happen until you're 70, right? But like you're trying to. Is that a fair statement? Sorry to interrupt, but like,
no, I mean, you've got to go through that math and understand. And for a lot of people, again, that like the strategy you're talking about and just hiring someone to work in their company and then continuing the business to operate just as them as an owner rather than an operator, that can work for a lot of people. But there's other people who may look at that and say that's too much risk concentration in that. So everybody's different, and there is no right or wrong answer. But it's having that knowledge and having that detail laid out in front of you that helps you to make an educated decision, and again, to eliminate remorse.
Right. And I think one of agreed. And I think just to super clarify, like, I just don't care what people do. And then, like, when I think about, like, one of the thing that I've honed in on, Dave, of, like, focus on the ownership framework and in understanding that operational role. And, like, the more you can clarify all this stuff, like, where's the company going strategically, roll that strategic plan, the value growth plan, into the financials, and figure out how to decouple your income from the operator role, at least frees yourself with all the options. Because every option we just talked about, they're gonna have to do that anyways. You know what I mean? And I think what happens is, I think there's this false perception of, like, if I find this one situation, I can retire my job, get all my money up front, and it equals the exact amount that I want. And it's like, most often you're going to have to do the hard work. It is like, unless you're willing to accept less value to buy your time back, which is fine. But then we just have to have a recalibration of what is the true value if you are no longer there, and someone's going to have to jump in and take over in like 6 to 12 months. What is to wrap here is size a client that is ideal for Prairie, and maybe a ideal, client range for your ESOP or private equity. Like, who's a perfect audience for you?
For most part, for our M&A folks and whatnot, I mean, when we look at things, I mean, I shouldn't say it for just, I mean, because again, it's broad, but I would say that our general client is probably, 5 million in EBITDA to 30 million in EBITDA. So, we do work with smaller companies, but that would be the bulk of the companies that we work with across the board. Certainly in the ESOP space, it gets much larger than that in a lot of instances, just because we're one of the biggest players in the country in that space. So we get brought into a whole lot of deals that have a lot more substance than that. But the bulk of who we deal with is the privately held business owner, usually founder-led or family owned business. Look to help them to guide through this, and so it's it can be and we're industry agnostic. For us, it's about serving the client well, educating them on value, educating them on potential structures, on how to optimize their process in the ownership transition that they're about to go through. So that's the bulk of what we do from a size standpoint.
And at that size too, you are truly available for any of those different options that we talked about. And I think this is where it's interesting. If I were to think about a Venn diagram, there's probably 80% of what I'm doing is right before that. There's to call it 20% that are in your wheelhouse. But like, I'd say, like, the people that like the people that are listening, it's like, if they do some of the work we're talking about, they can be ready for you. Right. Cause like to not have that opportunity to do the ESOP versus the private equity. I mean, I would love to have everybody have all those options because they hit that EBITDA number. And so I think it's also important for people to listen in. Where, like, the smaller you are too, there truly are just less options as far as, like, because I mean, you have cash flow constraints, right? I mean, that's where the ESOPs versus the private equity firms become just a different pool of buyers. But I think it's important for people to realize, like, you stay in it for a handful more years and do some of the stuff I'm talking about, you become an option, because otherwise that's not an option.
Well, and again, we're happy to talk to anyone, even if they're smaller than that. There's a lot of great companies. So a lot of it comes down to, if it is smaller than that, it comes down to, okay, is it an industry that we have experience with? Because that allows us to create greater efficiencies in going through that process. And what's the business all about? Because
how about the education of the owner? Like, the stuff that we're talking about, if someone came to you and just knew all this stuff and they were easy to work with because their expectations and education was aligned, I mean, would that impact your desire to get a deal done on 2 or 3 million in EBITDA?
No. I mean, we'd want to talk to them and make sure that our interests were aligned and whatnot. Again, I'm kind of giving you a snapshot of what the the heart of the bell curve is, but we've got a whole host of other, we might have 2 deals right now that are between 2.5 and 5 that we're working on, as we speak. So I mean, and for us too. I mean, for us to get into a conversation or to go through a lot of the education and just having pretty detailed discussions up front, it doesn't take an engagement. I mean, we're happy to go out and educate people because for us, it's like we want to help people, one, but also we know that if we help people and we do a good job and it's beneficial to them, even if we don't end up doing something for them, then it's likely that they pass.
They got friends.
To someone else. So it's like, hey, let's do everyone a favor if we can, and just get this right. Or they may grow into another company. I mean, we've got a company that we started working with. It's one of my first clients. It was like 24 years ago.
Oh, wow.
I think they were about 12 million in value, and now they're like 560 million, I think. And
how cool is that to see?
Businesses grow, and hopefully, I think if you talk to them, they'd say that some of what we obviously discussed and some of what we helped them with, it helped them to achieve that. But for us, it's about education, and we're certainly willing to give our time to talk to parties.
Well, I appreciate your time, Dave. I know it's crazy valuable. You've got a lot to manage at Prairie Capital Advisors, and you guys' ethos and just the integrity, all this stuff. I just appreciate it. And your guys' approach is awesome. And I've always valued our time, and I know the people that listen in also do. So I appreciate it so much.
All right. Well, thank you very much, Ryan.
Yeah, likewise. Thanks for tuning in. I hope you enjoyed that conversation with Dave. I absolutely am convicted that we need to understand how the game is played in the M&A marketplace and how capital allocation works and what the buyer's desires for returns are and how they get those returns. And then all the assumptions that are taking place during the deal, and then how the deal structures help match up the seller's goal and then the buyer's goal. Because if we don't understand this and we're learning this in the fly of a deal, all of the stress and the emotions become way magnified. And as you probably heard me say throughout the conversation with Dave, if we understand this stuff, it's just about matching expectations. Again, back to the whole iPhone or phone conversation. If we both agree on what value is and what creates value, then it's all about structuring the needs of both the buyer and the seller to get a deal done. And as long as everybody's very open and honest, like what are the assumptions? How are we going to get paid? All that stuff becomes easier to then match up the right expectations and to align a buyer and seller to get each other's goals accomplished. And I think what we need to understand is we can't, as a seller, get something by on a buyer, and a buyer shouldn't be able to get something by on us if we understand the technical details. And again, it's like chess. We're playing chess, or actually potentially 4D chess. And by understanding this stuff, it's a lot easier to match everything up and play the right game. And then what we can do is focus on the strategies and the players that are actually in front of us instead of learning the rules of the game and then what the actual pieces of the game are. That is why next week I've got Jeff Butner, who is a partner at Butcher Joseph. They're a firm very similar to Prairie Capital Advisors that does M&A deals in the middle market, private equity, ESOPs, third-party management buyouts, debt funding. And the reason I wanted him on the show is to talk about how all of those buyers have their own desires for rates of return and how they plan on getting those rates of return through a deal. And I think it'll give you a lot of context by this podcast episode for next week, because next week we're going to talk about what is the goal, and their goal, the buyer's goals, ESOP, private equity, third party, their goals on how they're going to generate free cash flow or rate of return and equity will impact what happens to the business afterwards. And so by understanding that component and the deal structures, you can better match up what your goals are with the right buyer whenever the time is possible for you. So thanks everybody for tuning in, and stay tuned for next week for Jeff Butner.